Hi, I want to welcome you to our 11th International Economics and Finance lecture. And this time, we're going to talk about monetary approach to exchange rates. So, basically, we're gonna discuss the theory that is telling us how exchange rates are behaving over the long period of time. So, what we're gonna discuss today is some preliminaries to the monetary model. So first, we're gonna simplify balance of payments that you discussed with Yana in details before, uh, we can model the monetary approach with bigger ease. Then we're going to move to something we already discussed in macroeconomics classes, which is price flexibility. This is a key component to macroeconomic adjustment, but it also a key component into international macroeconomics because, as you will see, the prices and their flexibility have very strong impact on how exchange rates will behave. Then we're going to discuss the monetary model, and we're going to start with fixed exchange rates, and then we're going to reformulate the same model. We're going to make it a little bit more sophisticated and in terms of logarithms to see what happens in case of flexible exchange rates. And also we're going to do it in this way because then we're going to test the model econometrically and we're going to see how well does it actually work. Okay, so let's proceed. So we're going to today use very simplified balance of payments, but it's something that you are probably already used to in different classes, like introduction to economic analysis. And our current account is going to be a trade balance. So basically, exports minus imports. Capital account is going to be just private capital account, and we're going to discuss only bonds. So, as you see over here, current account, which is in our case trade balance, is exports of goods minus imports of goods. Then, now that we've added bonds, we've got exports of bonds minus imports of bonds. And finally, the rest is going to be a reminder. In the reminder, we're going to have just, let's just say, holdings of gold and foreign currencies. And of course, this must be closing at 0. Okay, so with this out of the way, let's go to price flexibility. Now, look, we distinguish generally for demonstrative purposes and modeling purposes 3 different types of price flexibility. First one are fully flexible prices, which means that prices adjust to changes in economic conditions completely at any point in time. Look, this is the type of adjustment we expect to have in a long run. And every time when we were discussing long run models in either for example in macroeconomics class, that was the situation when we were relying on the assumption of fully flexible prices. And the thing is that fully flexible prices imply full employment. But remember, full employment doesn't mean that all the laborers are working. It just means that that the workforce is used effectively. So we very often call it that unemployment is at natural level. And of course, by changes in the structure of the economy or in law, we can move this natural level of unemployment. But of course, here this is not the point at this moment. We just notice that fully flexible prices are implying that the economy is running at optimal capacity. Uh, and of course, over here, what I already said is that fully flexible prices are bringing insights into the long run economic relationships. Okay, on the other hand, on the other side of the spectrum, we would have completely fixed prices. Completely fixed prices is the situation when prices are staying constant. This is something you've encountered in macroeconomics when you were discussing Keynesian cross or ISLM model, right? So, in this case, we of course rely on short run analysis. And having prices not being adjusted, there exists a possibility that we might have a disequilibrium in goods market. So unemployment actually goes above natural level. We are producing less than we could produce effectively because of the fact that prices in our economy have not been able to adjust to changing conditions. And again, as we said, this provides insight to short run economic relationships. Now, the third possibility is something that we've got in between the two. Those are sticky prices. This is a situation when we have a fixed or almost fixed prices in the short run, but after enough time has passed, they gradually adjust to their long run equilibrium level. And in this circumstance, they will be providing insights into both short and long run economic phenomena. And as you will see a little bit later, when we talk about sticky prices, the central role is taken by price expectations. Okay, so now that we know the three possible cases, at which case are we going to focus on? Look, monetary model is the long run model, as we already said. So of course, today we're going to assume that prices are fully flexible. And because the prices are fully flexible, we expect the economy to run at optimal full employment or at natural level. But how does it look in reality? And especially, look, as this is international economics class, and we should be able to compare how prices are changing with exchange rates. And this is what you see over here. Look, here you see the growth rate of price level in blue for the Eurozone between year 1999 and 2011, and on the in red you see growth rate, so percentage changes, of course also the same frequency for both prices and exchange rates. You see over here for dollar euro exchange rate. And look, the striking feature of this graph is that inflation, denoted in depicted in a blue color, is far less volatile and takes far lower values than exchange rates. So look, what we see actually in the real world is that exchange rates So prices of currencies are changing way faster, and they have way higher amplitude than prices of goods. And look, this is nothing that should come to you as a surprise. We already showed how volatile exchange rates can be, but the thing is that you would expect that prices, it takes time for the companies to change prices. They need to, you've discussed this during macroeconomics. You've got this menu cost. You need to print new prices. When you have contracts with your employees, they are usually written for a year or maybe 2 years, and because wages are already implied in there for a longer period of time, it is not convenient for the companies also to change price more often. But there are no restrictions as those in case of exchange rates. The exchange rates can actually change from day to day, even from hour to hour or minute to minute. Okay, so now that we know the differences between the two, we can move to modeling. And we're going to start with monetary model with fixed exchange rates. Okay, so let's start with the main idea. Look, exchange rate is simply price of one currency expressed in terms of other. So because exchange rate is a price, then it is a monetary phenomenon. It depends on money. It depends on how much money do we have in the economy. And by this token, this is how we also should balance of payments disequilibria. They are, in case of in the view of monetary theory, they are purely monetary phenomena. So they simply reflect differences, disbalance between domestic money demand and money supply. And look, the idea here is that if we do not have enough money in the economy because demand for money is higher than the money supplied by the government, it can be, this difference can be eliminated by either by inflow of money, or if money supply is higher than money demand, by outflow of money. So at this moment, we can already see the prism through which we should see exchange rates. We should see them through the prism of money market. And of course, now the only thing left is that we need to have adjustment mechanism. And our adjustment mechanism in this case are going to be fully flexible prices. Because of course, for now, we're gonna assume that exchange rate is simply fixed. Okay, so let's move on to the assumptions of the model. Look, we will have two countries. First, we're gonna call home, and all the variables with no subscript are the variables for home, and foreign as our second country. All the foreign variables are variables with subscript f. Now, as I already mentioned, we are having fixed exchange rates. We will denote it as S, spot as usual, and this is the price of foreign currency in terms of our currency. So how many units of domestic currency we need to pay for 1 unit of foreign currency? Now, we need to define money supply. And look, we're going to define money supply simply as the sum of domestic credit plus net foreign reserves. What are those net foreign reserves? look, if we go back to our first slide, too far. Look, this is going to be associated with the transfer of money that we see over here. So this is going to be the net position after we sum up trade balance and a private capital account balance. So whatever is left in here, either positive or negative, it can either increase or decrease money supply in our country. How can you imagine it? Look, let's just say that trading bonds closes at zero, but foreign countries are resident from foreign countries have imported more of our goods than so we exported more than we imported from foreign country. So what they need to do is to, for example, take the reserves of our currency that they had, and they need to pay for our export. So for what they imported. And because of that, our money supply is increasing. And because our money supply is increasing in this case, we can treat it as an increase in money supply due to net foreign reserves. And look, of course, we will have very similar situation with money supply in the foreign. It's also domestic credit, but domestic credit in foreign and foreign net foreign reserves. Okay, I know it sounds kind of funny, but I hope you get the idea. So now we need to define the money demand. So money demand in our model is going to be given by Cambridge money demand expression, where money demand is equal to velocity of money times the price level at home. And look, we're going to assume that velocity of money is constant. So actually, if we would cut it out completely out of the model, nothing would actually change. But I hope you see this relationship here, that if price level goes up, we need more money for purchases of goods and services. So money demand is increasing. Now, correspondingly, we have very similar money demand function at home. Well, actually identical, but of course with subscript f. Now, usually Cambridge money demand function also includes y, but in our model, as prices are fully flexible, y is always at its natural or potential level, so it wouldn't make a difference, so we're just going to ignore it. Now, moving on, let me introduce some new notation, but this new notation is not that new because we've been using it in dynamic economic analysis as well as advanced quantitative economics, those of you who participated in this class. And if you see some variable with a dot, it means that this is a derivative of this variable with respect to time. So what is x with a dot changing, telling us is that it depicts how this variable x is changing over time. And with this in mind, we can now show how the short-run money market adjustment is working at home. So look, m with a dot is simply first derivative of money supply with respect to time. And so this is the change in money supply. It's equal to money demand, as you see, VP, minus money supply. And look, and here we have this alpha, which is adjustment coefficient. I'm going to show you what it represents a little bit closer in a second. let me just explain that in this case, I hope you can see that if money demand is higher than money supply, we will observe that the change in money is going to be positive. So we will observe some inflow of money. How is it happening? In a second. And look, similarly, we have the same market adjustment mechanism in foreign, with, so everything stays the same but with subscript F. Then we are assuming that we are producing only one good in this economy. So the final thing to connect the two markets, the two economies within one model, is the law of one price. So we are assuming that price of this good in our country is equal to exchange rate times price of the foreign currency. As we remember, S represents how many units of our currency we need to pay for 1 unit of foreign currency. So basically, due to putting exchange rate over here, we see that we have prices expressed in the same currency on both sides of the equation. Okay, so now let me give you some explanations. First, let's look at this short-run market adjustment mechanism at home, and look, we can see it as a differential equation, the same type of differential equation we've been dealing with in dynamic economic analysis. What am I talking about in here? Look, here is the derivative of m with respect to time. If I, for example, gonna calculate all this, and I'm gonna take alpha times m and put on the other hand side of the equation and leave alpha vp over here, we're gonna have exactly the same type of equation we've been dealing in dynamic economic analysis. And look, we can easily find the solution to it because this is the simplest type of differential equation with constant coefficient and constant term. And we see that in long run, money, the amount of money is equal to money demanded, and over here we see that deviation from if money supply is supplied is different than money demanded, so this deviation is eliminated over time. And of course, the speed of adjustment here depends on coefficient of adjustment. So you see that every time when there is disparity between the two, it will diminish over time. So we have convergence over here because alpha is positive, and the bigger the coefficient of adjustment, the faster it is going to happen. Okay, but what exactly this adjustment process represents and how is it done? Look, if we go back to equation 10, we will see that if money demand is higher than money supplied, we will have positive change in money. We will call this situation that home residents are hoarding money. How do they do it? Well, they just spend less income. Like if they demand more money, then their money that is supplied to them, they do not have enough money to spend, and by this behavior, they can hoard money from another country. How do they do it? Well, this is actually quite easy. Look, if they spend less, it means that they import less. But remember, we are still at full capacity, so we always produce the same amount. So what we do not what we produce but we do not buy, we sell abroad. Also, if we spend less money, it means we buy less from abroad. We're running current account surplus, so the money through, for example, net foreign reserves are going to our country. And look, at the same time, foreign residents must be discording. So the situation there is reversed. So then their money demand is lower than money supplied, and of course their money supply is shrinking. Why? Because they are transferring money from their country to ours. Okay, and now look, knowing this, we are actually ready to graph the monetary model. But there is one tricky thing we need to go through before we do so. Look, here we have shown an adjustment mechanism from the perspective of home country. Here it is depicted from the perspective of foreign country. So what we need to do now is to transform this foreign adjustment mechanism into domestic one. How do we do it? Look, first thing that we need to do is to multiply both sides of this equation by -1. Because look, whatever we are gaining, they are losing in terms of money, and vice versa. So we need to introduce minus. But look, there is a second problem. This equation is expressed in foreign currency. So before we can actually use it and depict everything in one graph, we need to make it into domestic currency. So we multiply now both sides by the exchange rate. And look, now that we do so, I can multiply everything by exchange rate inside the parentheses. And because of the law of one price, we said that P is equal to SPF. So I can substitute exchange rate times foreign price level by domestic price level. And this is how we obtain the equation that we are going to use. So now we are ready to start graphing the model. So here is the graph, and what we can see over here is that we've got two axes. On horizontal axis, we have change in the money supply. As you see, it refers to both money supply at home and money supply in foreign. Of course, as you can see over here, we've multiplied change in money supply by exchange rate in order to get in order to denominate money supply in our currency. And you see, of course, a minus, because if money supply at home is increasing, right? So it's positive. Then the money supply in foreign must be decreasing because we are taking money from the other country. Now, on the horizontal axis, we've got price level. And look, the two equations that build up the model, along with the law of one price, now are corresponding to two lines. The first line you see over here, we will call hoarding. Why this line is called hoarding? Look, let's see what happens as the price level increases. When price level increases, money demand is higher than money supply. So, what is happening now? We've got people at home, agents at home, need to start hoarding money. They will do it by spending less income. And look, it makes perfect sense. The higher is the price level, the less people want to spend. And we see that this expression then is getting simply bigger and bigger and bigger. So this is why we get this positive relationship. But look, at the same time, this must be corresponding to this hoarding, and this is how we're going to call this line in foreign. Because here people will be now spending more income, and this income is going to be redistributed between the two countries. Look, at point E0, we see the short run equilibrium. And look, what does this equilibrium imply? Look, at this equilibrium, we see that the change in money stock at home is positive, which of course means that change in the money stock in foreign must be negative. So we observe transfer of money from foreign to home. But of course, look, this is just a short-run equilibrium. Things are gonna be changing over time. Why? Look, if agents at home are now spending less, it means that domestic income is bigger than domestic spending, right? Because remember, we are still assuming that we have output at potential level. But what does it imply? Like, it means we must have current account surplus. It means we produce the same, we buy less. So we sell more abroad. And this causes an inflow of assets. And those assets, like foreign reserves of foreign currency, so our currency, are flowing to home. And because of that, we see increase in the money supply. But look, if money supply is increasing, we will observe that actually the line here needs to shift. It will shift upwards, and it will shift upwards because with bigger money supply, the relationship stays the same. It's still upward sloping, but now with bigger money supply, the required excess in money of money demand over money supply it must be simply bigger. And look, the opposite we observe in case of foreign money supply, because if foreign money supply has now fallen, so we move over here actually to a new short-run equilibrium. And look, as the process goes on, as long as change in money supply is positive for home and negative for foreign, this adjustment will continue. And this adjustment, of course, will stop at the moment when both curves for hoarding and dishoarding are going to intercept at zero. So at some price level, that is some price level for which change in money supply in both foreign and home is going to be zero. So it's gonna stop changing. This is how we reach long run equilibrium in the model. But look, the important thing to mention over here is that this effect on prices is undetermined. Look, it actually depends on the relative strength of alpha and alpha f. If alpha is higher than alpha f, the price level is going to increase. If alpha f is higher than alpha, it's going to decrease, but if the two are equal to each other, the price level is going to stay exactly the same. Look, we can see that by calculating the equilibrium price. How do we do it? Look, we simply equalize domestic hoarding and foreign dishoarding. After a couple of very simple algebraic manipulations, we can get equilibrium price. And look, we see that the distribution of money here between the two countries strongly depend on parameters alpha, so coefficients of adjustment. In a case where they would be equal, look, this the price, the equilibrium price is simply equal to the sum of supplies plus sum over sum of velocities. So even though price level is undetermined, we can clearly see that the full adjustment in this model is going through prices. And look, it should not come to you as a surprise, because this is a monetary model. We don't even have a goods market in this model. And if we don't have a goods market in this model, definitely changes in money supply must be transmitted through changes in price. And this is the equilibrating mechanism. Okay, but now we were assuming thus far that we have fixed exchange rates. Because we have fixed exchange rates, we were assuming that that exchange rate simply stays at the same level. But within exchange rate regime, we can have devaluation. So central bank can decide to decrease the value of our currency. Okay, so now let's examine a situation like this. Look, let's say that at the beginning we are at the long run equilibrium over here. So we've got this hoarding and we've got a hoarding schedule. Now, let's say that central bank decides to devaluate the currency. So S0 is increasing to S1, right? So now we need to simply pay more units of our currency, more units of our currency for 1 unit of foreign currency. And look, as a result, this hoarding in foreign is moving upwards. Okay, but before we go to all the adjustment through all the entire adjustment process, let me just put your attention into a couple of things over here. Look, this E0 here is not only denoting equilibrium, but actually at this point we see the initial price level at home. So what is going to happen in this economy? Look, first, let's notice the law of one price. If price level at home would stay the same and we would have devaluation, if we go back to the law of one price, what would we see? Prices here are staying the same. We've got devaluation, so S is going up. So for this relationship to hold, what must happen? Of course, prices in foreign need to fall proportionally to devaluation. Well, but what would happen then next? Well, if prices in foreign would fall, of course, we would expect uh, uh, money demand in foreign to fall as well. And as money demand decreases in foreign, foreigners have incentive to discord at current domestic prices, right? So this would be the initial effect. But however, we should notice a couple other things, because as an outcome of devaluation, the dishoarding line moves upwards, we will see that the new short-run equilibrium is going to be at E1. And look, at E1, we've got price level P1. But this price level is somewhere in between E0 and E prime. What would be this E prime? Look, E prime would be the price level that we would have if devaluation would be completely absorbed by the changes in price level, right? But because we have a situation that short-run equilibrium price is somewhere in between E0 and E prime, we see that actually prices measured in foreign currency measured in foreign currency have actually fallen. So what is going to happen? Look, because now this devaluation has not been fully absorbed by prices, we should observe that home is going to have current account surplus. But of course, as prices in foreign have fallen, purchasing power of money balances, so all the cash held by foreigners, is going up, which again is contributing to current account surplus. And this, in the end, will lead to further increase in domestic prices. Why? Look, this, you can think about it as a higher demand for home goods, and as a result, the long-run equilibrium will be at point E. So, what are the consequences of devaluation in monetary model? Well, in monetary model, we see that positive effect of devaluation on current account is only temporary, and as prices adjust, it completely disappears. Okay, so for thus far, we've been discussing monetary model with fixed exchange rate. Now let's go to flexible exchange rate, but this time we will have a little bit of a trouble, because drawing this model is not as easy. So we will have to just rely on the we will have to just rely on the we will have to rely on formulas. Okay, so let's reformulate the model. Okay, now we will have real money supply equal to money demand, and they both are going to be in logarithmic form. So real money supply is m over p, but of course in logarithms we can change it into m minus p, just like we did before. And look here, of course, we've got money demand that you are more used to it. We've got transaction demand, so positive relationship between money demand and GDP, as well as negative relationship between interest rate and money demand, so the speculative motive. And we've got exactly the same situation at home. I'm sorry, here should be, of course, lower y, because we remember that lowercase letters for us represent logarithms. Okay, so now look, law of one price in logarithmic form, we had p times equals to s times pf, can also be transformed through logarithms into p logarithm of price level equals to s plus pf. Now, look, if we are going to solve a 25 I'm sorry, I think here is a mistake. We need to solve, if we're going to solve 24 for a logarithm of foreign price, and we're going to substitute it into 24, we're going to obtain equation 26, the way you see it over here. And then if we're going to take 26 and we're gonna substitute it into 23. I don't know where I got these numbers. Probably the indexes must have moved when I added more equations. We're gonna end up with equation 27. And now, if I'm gonna solve equation 27 for nominal exchange rate, what I'm gonna get over here is an equation where I have when exchange rate is logarithm of exchange rate is expressed as a difference in logarithms in money supplies times alpha times minus alpha times y, so logarithm of GDP at home minus GDP in foreign, and the same for interest rates with coefficient beta. Now, let's notice one trick we did over here. Actually, that doesn't need to look like this. Look, we've assumed that parameters, the coefficients in money demand, are the same in both countries. It doesn't need to be like that, but as you will see, actually, the theory, the empirical evidence that I'm going to demonstrate to you in a couple of minutes are supporting this case very strongly. So, the equation that we've got is over here. And look, from this equation, we can get three main conclusions. First, if money supply at home is increasing faster than money supply in foreign country, we should see increase in exchange rate, domestic exchange rate. So what does it mean? It means depreciation. And look, it makes perfect sense. If there is more of our money on the market than foreign money, then our money is losing value. So we should expect depreciation. On the other hand, we see that increase in home GDP relative to foreign GDP causes a decrease in exchange rate, right? So we will observe domestic currency appreciation. This channel we're going to discuss in more detail in the future. The same as with interest rate channel. But look, from this equation, we again can clearly see that increase in home interest rate relative to foreign interest rate should contribute to depreciation of domestic currency. Okay, so this model is very nice because we can very easily check it empirically. And look, we're gonna ignore interest rates, not to complicate too much. Plus, as you will see, having having money supply and GDP will be quite enough, especially that we're going to consider a very, very long run model. This is going to be 29, actually 30 years time perspective. And as we mentioned before, interest rates are important in determining exchange rate in the short and medium run, but they do not have this. They do not contribute in the long. Okay, so what is the specification we are going to test? Look, we are taking data on 70 different countries, 72, and we refer them each to United States. So here you see the exchange rate against the United States of country J in 2009 minus exchange rate of country J in 1970. Look, because those are in logarithms, we've got the growth rate. So we've got basically the change in exchange rate over this 30-year period. Then we've got some constant gamma. We've got alpha, the parameter from the model. And look, what do we see here? Here is a growth rate of GDP between, so by how many percent GDP has grown between 1917 and 2009 in comparison to the same with the US. And here we've got some this parameter alpha. We also got parameter gamma for a expression that has growth rate of money supply in country J minus the growth rate of money supply in US. And now look, after estimating this equation, what do we get? Look, those are the parameters we got. So there is a constant, and it's statistically significant. What it means that there is at least part of this change in exchange rates that cannot be attributed to both money supply and GDP changes. Then we see that the parameter on the GDP differences is slightly above 1, is statistically significant at any conventional level, and we see that it's actually very close to 1. Our theory did not require it, but this is what happens. But the more interesting case is that, look, the theory predicted 1-for-1 increase in exchange rate with respect to differences in money supply growth. And look, this is what we got, because here, even though we've got 1.001, the hypothesis that exchange rate is equal to, that the coefficient gamma is equal to 1 cannot be rejected. Again, let's one more important thing is that in this situation we see that R square is equal to 0.99. So this model actually fits the data extremely well. Okay, now I want to show you this on a graph, but before we can do so, we need to make some corrections. Look, if I want to put on if I want to put on one graph, for example, changes in exchange rate and changes in money supply, in order to make the graph fit properly, I need to first make corrections for output. How do I do it? Look, I just simply subtract from changes in exchange rate. I'm sorry, this constant should not be here. When I was copying it, it appeared, but it shouldn't be here. I just make the correction for changes for differences in output growth times the estimated coefficient. This is how I get correct exchange rate corrected for output, and in exactly the same way, I get I make the correction for differences in money supply. And now let's look at it on a graph. Look, here we have differences in money supply growth, and here we have exchange rate corrected for output. Look, they look here that we see over here that we've got a line basically going through through the origin and has a slope of 1. Uh, now, we can also see over here that when the differences in money supply growth rates are very small, like in case of Switzerland, exchange rates between US and Switzerland stay more or less at the same level, so it's very close to zero. But in countries that experienced very high money supply growth, like Argentina, Brazil, or Congo, we see that this is again almost one for one reflected in exchange rate. But of course, here we see that those changes were extremely big. Now, very similar pattern, although not as good, not as close, we see with output. We see that output growth rates, again, are explaining changes in exchange rate very, very well. Although here those points are not fitting the line so close. Why is it so? Look, intact with our model, we made this assumption that a transactional demand parameter is the same in both countries, which of course doesn't need to be true. So in our simplification, we might got some things wrong. But look, still, you see, I hope you can see from this very simple example that monetary model works extremely, extremely well in the long run. And especially the differences in money supply growth rates in the long run are translated one for one to changes in exchange rate. Okay, thank you for your attention. This is it for today. Next week we're gonna go back to the blackboard and we're gonna see what happens in the to exchange rates in the short run, and we're also gonna use short run analysis, so analysis with fixed prices, to examine the effectiveness of fiscal and monetary policy under fixed and flexible exchange rates. So, as you might expect, we're going to go back to ISLM BP model, but this time we're going to focus our attention mainly on the channels that are of monetary and fiscal policy that work through the balance of payments. So, thank you for your attention and see you next week.